You know, in business, it's often what you can't see that makes or breaks you. Today, we're going to dive deep beneath the surface of the typical sales report to explore a really powerful concept called cost to serve. It's all about uncovering the hidden costs that tell you which parts of your business are actually making you money and which ones might be secretly draining your profits.
So let's start with a really common trap, something I call the profitability illusion. This is where our standard everyday accounting practices can, and often do, paint a dangerously misleading picture of a company's health, lulling managers into a completely false sense of security.
And disillusion, well, it forces us to ask a pretty uncomfortable question. A question that every business leader really needs to ask themselves. What if your very best customers, the ones bringing in the most sales, are actually losing you money? Sounds crazy, right? But believe me, it happens a lot more than you'd think.
Okay, let's make this real. Take a look at these two customers. We'll just call them Customer A and Customer B. Now, on the surface, they look exactly the same, right? Both of them bring in $250,000 in sales every year. If you were just looking at a standard sales report, you'd say, great, they're both equally valuable. But are they really?
So where does this all go wrong? Well, it comes down to a practice that some people pretty brilliantly call peanut butter costing. Just think about it. Traditional accounting takes all those background costs, warehousing, customer service, shipping, and just smears them evenly across all your customers, like spreading peanut butter on a piece of bread. It's simple, for sure, but it's based on one giant flawed assumption, that every single customer costs the same to serve. And that's just not true. A much, much better way to think about this is the iceberg. That $250,000 in revenue, that's just the tip. That's all you see. But the real danger, the real story, is hidden below the water. It's that massive hidden chunk of unequal service costs. And that's where true profitability is either made or lost.
So the big question is, how do we see what's lurking below the surface? We need a tool, right? A diagnostic tool. And that tool is the cost to serve methodology. Think of it like an X-ray for your business, allowing us to see the real, true profitability of every single part of your operation. Okay, so what is cost to serve? We often call it CTS for short. At its core, it's a methodology for pinpointing all the supply chain costs and attaching them directly to the specific customer or the specific product that actually caused them. It's the complete opposite of that peanut butter approach we talked about. It's all about precision. Now, some of you might have heard of a similar concept called activity-based costing, or ABC. It's really important to know the difference. Think of it like this. ABC is like a huge, broad spotlight that shines on the costs of the entire company. Cost to serve, on the other hand, uses the exact same powerful logic, but it's a much more focused spotlight. It's aimed squarely at the supply chain and all the logistics activities.
And really, the whole point of doing a CTS analysis comes down to this. We want to get past that simple gross margin number. We want to calculate a true, honest-to-goodness net margin for every single customer and product. It's about creating this undeniable link between what happens every day on the warehouse floor and what shows up on the financial statements at the end of the year.
All right, so let's pop the hood and take a look at the anatomy of these service costs. What exactly are we talking about here? What are we actually measuring? A good CTS model breaks everything down into what we call cost buckets. These are just the main activities that eat up time and money. So we're talking about things like order processing and customer service calls, all the warehousing and handling costs, transportation, of course, but also things you might not think about, like managing returns, and even the financial costs of just having inventory sitting on a shelf. Okay, now this is where the rubber really meets the road. Take a good look at this table. You'll see both customers buy the exact same number of units, but their behavior is completely different. Customer A is simple, 4 big orders, done. But customer B, they place 100 tiny little orders. Now look at the impact that one difference has. Look right at the bottom line. It costs nearly $18 per unit to serve customer B, but less than $4 for customer A. That's incredible. Same sales, but a completely different cost story.
Okay, theory is great, but let's get practical. To really see how powerful this is, we're going to walk through a real case study. Let's do the math together.
So here's our setup. We've got a company called Pro Parts. They sell a component for $100. It costs them $60 to make, so their gross margin is $40 per unit. Simple enough.
Now they've done their homework and they figured out the cost of their key activities. It costs them $50 every time they process an order, $5 for every line item someone has to pick in the warehouse, $300 for each delivery truck that goes out, and $150 for every single return they have to handle.
All right, now let's apply those numbers to two different customers, X and Y. And here's the key. They both buy 500 units. So first, look at customer X. They're easy, low maintenance. Their total cost to serve comes out to just under $1,800. Not bad. But now, look at customer Y. This is our high-maintenance, high-complexity customer. Lots of small orders, lots of returns. Their total cost to serve, it explodes to over $20,000. Now for the big reveal. In step 3, we take the gross margin, which is $20,000 for both of them, and we subtract these service costs.
And wow, this bar chart tells the whole story. This is the moment of truth. Customer X, over on the left, is a superstar, bringing in over $18,000 in pure net profit. But customer Y, the one with the exact same sales volume, is actually losing the company money. They're in the red, a net loss.
This is a perfect textbook example of what we call the leaky bucket effect. Think about it. That $20,000 in revenue from customer Y got poured into the top of the bucket, but their behavior, all those small orders, extra deliveries, and returns, punched a ton of little holes in the bucket, and all the profit just leaked out before it ever hit the bottom line.
Okay, so knowing this is huge. It's a massive insight, but insight without action is, well, pretty useless. The real magic happens when you turn this knowledge into a plan. So let's talk about the treatment plan.
So what can you, as a manager, actually do with this data? Well, there are 3 really powerful moves you can make. First, customer segmentation. You can finally rank your customers based on who's actually making you money. Second, you can create a menu-based pricing system. Basically, you stop giving away expensive services for free and you start charging for them. And third, SKU rationalization. You can finally look at your entire product catalog and figure out which items are actually worth the effort of selling.
Now, I should be clear, this isn't a walk in the park to implement. The first big challenge is usually technical. Most companies have what we call data silos. The financial data is in one system, the warehouse activities in another, and the customer information is in a third. And these systems don't talk to each other. So just getting all that data into one place, that can be a huge project.
And honestly, the second challenge is often even bigger. And it's not about technology, it's about people. It's political. When you suddenly have this much transparency, it can make people nervous. Think about a sales team that gets paid based on total revenue. All of a sudden, their biggest customer might look like a money loser. This can create a real tug-of-war between sales, operations, and finance. That's why you absolutely need strong leadership from the very top to make this work.
So let's wrap this up by zooming out a little and looking beyond just the bottom line to think about the bigger picture and where this kind of thinking can take us in the future. If you remember one thing from all this, let it be this. Cost to serve completely changes the conversation inside a company. It stops people from just asking, how much did we sell? And gets them to ask the much, much smarter question. How much do we actually earn from that sale? That shift is a total game changer.
And I want to leave you with one last idea to think about. What if we took this exact same powerful logic and applied it to something beyond dollars and cents? What if we used it to track our carbon footprint? Imagine if you could trace the carbon emissions from every single activity, all the way back to the specific product or customer that caused it. The future of supply chain isn't just about cost to serve. It could very well be about carbon to serve. Something to think about.